Hello and welcome. Today we are going to learn about a technical indicator known as average true range. Developed by J. Wells Wilder, average true range is an indicator that it measures volatility and does not provide indication of price direction. Wilder started with a concept called true range, which is defined as the greatest of three methods. Method 1, current high less current low. Method 2, current high less previous close, absolute value. Method 3, current low less previous close, absolute value. Absolute values are taken to ensure positive numbers. If current high is higher than previous high and low is below low, then current true range is used for true range. This is an outside day that would be used by method 1 to calculate true range. Method 2 and 3 are used when there is a gap or an inside day. A gap occurs when the previous high is higher than current high, signaling a move, a gap down or limit move, or the previous low is lower than current low, signaling a gap up or a limit move. Example A. A small high-low range formed after a gap up. The TR is equal to the absolute value of the difference between the current high and the previous close. Example B. The small high-low range formed after a gap down. The TR is equal to the absolute value of the difference between the previous close and current low. Example C. Even though the current close is within the previous high-low range, the current high-low range is quite small, and in fact it is smaller than the absolute value of the difference between the current high and previous close. And this value is used to measure to value true range. Absolute true value. Average true range is based on 14-day period, as you can see from this triple Q price data. That average true range is based on first 14. The first true range is simply the difference between the high and the low, as you can see from this chart. The first ATR value does not come in after till 15th day. The first ATR, the first 14-day ATR is the average of the average of daily TR value of the last 14 days. The first ATR does not kick in until day 15. Current ATR, now the formula is for calculating ATR is current ATR is equal to prior true range into 13 plus current true range divided by 14. Now, as you can see from this price chart of power shares triple Q trust, as soon as you can see that their candlesticks start moving up in high volatility, the ATR also starts rising up and shows that it moved from 0.6 value to 0.8 jump. Now this shows that volatility started increasing and there were more buyers and sellers in the market, and more bulls and bears were interacting in the trading. The trading was high in this period compared to this previous period. Now ATR is based on true range, which uses absolute price changes. This means that the shares with low price will have low ATRs compared with shares with high ATR, high prices. They will have high ATRs, which means the ATRs are not comparable because absolute values are used by true range in calculating the ATR. As you can see from this Google and Microsoft chart, Google price is very high in dollars. It ranges from 460 to 590 during this 6-month period. And Microsoft chart, you can see it, the price ranges from $24.5 to $31.5. You can see that ATR, even though the lines of ATR are quite similar, but the volatility value, the ATR value, it is quite different. It is quite high for the Google because its share price is in high, and Microsoft, it is very low. It is from 0.5 to 0.9. For Google, it ranges from $10 to $16. ATR is not a directional indicator like MACD or RSI. Rather, it is a unique volatility indicator that reflects the interest or disinterest in a move. A bullish reversal with an increase in ATR would show a buying pressure and reinforce reversal. A bear support break with increase in ATR would show a selling pressure and would reinforce a support break. Thank you so much.